Welcome back. This is Ask the Compound, the show where you supply us the questions, we supply the answers. On today's show, we're covering questions about how to tell the difference between a secular and cyclical bull and bear market, the difference between investing in total market index funds and S&P 500 index funds, how to value a pension for a teacher, how a regular stream of income should impact your risk profile, and when to sell big winners in your portfolio. Remember, if you have an email for us and a question, email us here, askthecompoundshow@gmail.com. Today's Ask the Compound is brought to you by Rocket Money. Rocket Money is a personal finance app that finds and cancels your unwanted subscriptions, monitors your spending, helps lower your bills so you can grow your savings. I looked at my Rocket Money just this morning, and I love the planning feature. I'm a planner. We've mentioned the form of a spreadsheet guy. It says you have 11 recurring charges in the next 11 days. So I'm looking at bills that are coming up, subscriptions, payments that are coming in. It's kind of nice for the planning purposes. It looks at your spending levels this month versus last month, which is kind of cool. So I love the planning aspect of Rocket Money. They also negotiate on your behalf. It says, hey, well, my kids have these watches through Verizon, and it's like $9.99 a month, and it tells me where they are. You can text them through it. It makes fart noises for my son, which he likes. And it also, but they said, well, hey, listen, we'll negotiate with Verizon to lower your bill. So, hey, have at it. Take it for me, Rocket Money. 5 million users on Rocket Money. They've saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all the app's features. Stop wasting money on things you don't use. Cancel your unwanted subscriptions today by going to rocketmoney.com/ATC. That's rocketmoney.com/ATC.
And, not to brag, but my Rocket Money right now says I'm $262 below last month's spending. So,
all right. That's alpha.
Yeah.
That's spending alpha.
There you go.
All right. Last week, Duncan told me that I need to remind the audience that I'm not just a YouTube podcast pundit. I have a day job, darn it. And I need to tell people my resume. So Daniel, throw up my little meme here. I love the Winnie the Pooh meme. Resume and curriculum vitae. Barry likes to use that one. CV is also, if you want to sound smart.
And we don't remember if it's vitae or vitae. I took 4 years of Latin, and I don't even remember. So if anyone knows.
4 years of Latin. Okay.
Yeah.
So I don't like to talk about myself. Here we go. I am the Director of Institutional Asset Management at Ritholtz Wealth. I work with nonprofit and family office clients. I also talk to all of our other clients if need be. I sit on our investment committee where we set the direction for client portfolios, asset allocations, investment strategies. We manage over $5 billion, not to brag, so we're doing okay for ourselves. I've been in the business for 20 years now, working with clients of all shapes and sizes, from individuals to large institutions. What do you think? How did I do, Duncan? Is that good enough?
I mean, I'd listen to you.
Okay.
Yeah.
You don't listen to me, though. I give you advice all the time. You never listen to me.
I meant I'll listen to you.
Okay, you listen.
I'll listen. Yeah.
You're like my children, in one ear and out the other.
Yeah. There you go.
All right,
Yeah.
There we go.
And
that's
for
my
those of you that are
CV.
new, for those that are new here, I'm not a financial professional. I am the layman that asks, questions because I have lots of questions. I'm just a creative.
You're the straight guy on
I'm a
the
producer,
two, right?
Yeah, I'm a podcast producer. So yeah, don't comment. That Duncan guy doesn't really seem to know that much about finance.
Good questions today. I love the fact that a lot of times we will answer a question and that'll lead to more questions on top of questions. We got a few of those today, so let's get into them.
Right. All right, let's do it. Up first, we have a question from Anthony, I believe. I've heard Ben mention several times recently that we're in year 15 of a bull market, clearly referencing the end of the GFC in 2009 as the start of the current market cycle. Have we not had bear markets in 2020 and 2022, defined as 20% declines from the high? When you had Tom Lee on TCAF last year, and not to brag, we just recently had him on again, he said 2024 would be year 2 of a bull market. So he appears to have a different definition. Can you please explain how people in finance define the beginning and end of cyclical markets? This is a good question. I have no idea.
Fair question. And it was in relation to a recent blog post I wrote. Daniel gave me a chart on here. I just wrote a blog post comparing the 2009 start point to 1982 to 99 bull market, saying it's pretty similar. You can see there's some variations in there. They had the 87 crash. We had the 2020 crash. You can do chart off. The problem is these things aren't exactly scientific. So there are some loosely held definitions, but you have secular bull and bear markets, which are the longer term ones. But then within those secular bull and bear markets, you have cyclical bull and bear markets, which are counter trend rallies or downturns. And so things can get a little murky when we're trying to define these. So different investors have different rules for this stuff. When you hit the reset button and start over, one standard definition for most people is just a 20% bear market, 20% downturn or worse is a bear market, and that resets things, totally reset. I don't know. Let's see. So we've had 2 of those in the 2020s. So you could say, okay,
20% bear market, 10% is just a correction.
10% correction, 20% bear market.
15% just a correction still?
No, 15%. Yeah, 50% is a correction. 19.9% still a correction. 20% bear market.
Okay.
So your Daniel Research publishes these historical bull and bear market tables, which is pretty good. You can get them for free on the internet. They go back to the 1920s. So Daniel, do a chart on from your table on, I guess. This one is their bull market, and you can they show all the bull markets going back to 1928. You can see there's a lot of them, 20 plus. And in the bottom, in the little fine print there, it says bull markets shown are gains between bear markets defined as declines of 20% or more. Daniel, do the next one, which is bear markets. You can see they're pretty even, right? Every time there's a 20% correction, we start over. I think. Wait, one more. Do the next chart here, Daniel. This kind of shows this visually. This is the one we created that shows the bull and bear markets visually. You can see there's the good thing about bull markets is they more than outweigh the bear markets in terms of duration and magnitude. So, but this is a pretty way of looking at this. Here's my problem with these definitions. You can do a chart off. Some of these were just counter trend rallies. So there is a bull market listed on this table from the end of 1929 to the early 1930 when stocks rose 50%. But that was still within the context of a secular bull market where the stock market declined 80+%. So yeah, we had a counter trend rally there. Stocks went up, but you were still in the midst of a longer term bear market. The 1980s, 87 crash was the opposite. Longer term trend in the 80s and 90s, but you had a 1987 crash. And I look at COVID as much of the same thing. No one really thinks the 1980s bull market ended with the 1987 crash. That was just a counter trend crash. And I think 2022 was more of a run of the mill bear market. It's like borderline correction into bear market territory. So here's how I look at it from a secular basis. Daniel, do my last chart on here. I looked at this before. So these are longer term trends. These are real returns, inflation adjusted. And you can see we go through these periods of flattish to no returns, and you have like lost decades. And then you have these huge multi-year periods, multi-decade periods where you have double-digit returns. So from 1928 to 1941, stocks basically went nowhere after inflation. 1942 to 1965, you own almost 13% real returns. Again, these are after inflation. 1966 to 81, again, lost decade and a half. 82 to 99, 15% real returns after inflation. Another lost decade, 2000 to 2008. Then 2009 to now, we're talking 12% real returns again. So you have these longer term cycles where you go nowhere and then you go a lot of places. Chart off. So you could quibble with my start and end points here, but the point is that these secular markets, there's plenty of counter trend rallies. So 1942 to 1965, I contend, was one of the longest bull markets in history, 13% after inflation. But within that secular bull, there were 4 different bear markets in 1946, in 1948 and 49, 1957, and 1961 and 62. So you had these run-of-the-mill bear markets, but none of them approached 30%. So I think there's a difference between a bear market and a crash. A crash can kind of reset things. So I think the big difference between the current version of the bull market and previous versions were this bull market started at the bottom, if we're going by Ben Carlson definition. So the stock market bottomed in 1932, but the bull market didn't start until 1942. Stock market bottomed in 1974, but the bull market didn't start until 1982. You had these sideways patterns. That didn't happen this time. So what changed? Well, monetary and fiscal stimulus changed. The Fed stepped in and the government stepped in with a bazooka. So I'm not saying we can't have extended bear markets anymore, but the addition of fiscal and monetary stimulus means those worst downturns, the snapbacks, are going to be way quicker. So
I thought you were going to say money printer go burr.
I'm too old to use the term burr. So now, this entire conversation is a bit of semantics and splitting hairs, I suppose, but so are most historical stock market conversations. Like, markets don't operate like physics, so this is what makes them interesting to argue about, is that different people can have different definitions, and there's no scientific relationships with this stuff. So that's, and I guess it does kind of matter because, well, this bull market's getting long in the tooth. It's a 9th inning, but yeah, there's no standard definitions for this stuff. The bull market has to last this long. Bull markets do not die of old age.
What inning are we in right now?
We've been in the 7th inning since 2013. It's a really long 7th inning stretch.
Wow. Okay.
Yeah.
I can't even imagine what the score is then. Dan, can you throw up the iceberg-looking chart for a second? I have a follow-up question. I think it was 2 charts back. Yeah, this one. I mean, call me crazy, but isn't this all you need to look at to say that it makes more sense to be bullish over a long term instead of a perma bear? I mean, isn't that what we're looking at here?
Yes, but it only takes.
Someone looks at this and says, "I'm going to be short the market or be in cash every year, year after year after year."
The financial system only has to end once for them to be right, though, Duncan.
Okay.
All they need to be right is one time. That's it.
I see. Okay.
Next question.
Cool chart. All right, up next we have another Anthony. So this question is, I'm relatively new to investing and have learned about the benefits of owning the entire market. When looking at the performance of the S&P 500 versus the total market, it's nearly identical. When the S&P has done great, the total market has done great. And when the S&P has done poorly, the total market has done poorly, even if small caps performed well. This being the case, can't you make the argument that adding small caps to your portfolio adds diversification, since small caps in the total market don't really add much in terms of overall performance?
Yeah, astute observation by Anthony here. Daniel, chart on here. I just did the returns for the Vanguard Total Stock Market ETF, VTI, versus the Vanguard S&P 500 ETF, VOO. This goes back to 2010-ish, and you can see the returns are almost identical. The wiggles in the lines are identical. The S&P has done a little better. It's pretty darn close. If you go back to the turn of the century, the total stock market returns a little better. If you go back to the 1990s, maybe it flips a little bit. But the thing is, the total stock market return, which is essentially the Russell 3000 or something very similar to that, is very similar to the S&P 500. The biggest stocks in the S&P are going to be the biggest stocks in the total stock market index fund. As Anthony mentioned, the biggest difference is the small cap piece. So Daniel, do the next chart. I looked at the exposures here, and you can see there's a little more large cap exposure in VOO, which is, again, the S&P 500. The total stock market fund has 8.5% in small caps, whereas the VOO has barely any in small caps. So that's your biggest difference. Slightly more exposure to large caps in the S&P, slightly more exposure to small caps in the total stock market fund. So that's pretty much it. Chart off. If small caps under or outperform considerably, there could be some performance differences, but over the long haul, they're going to be pretty similar. It's not that much of a difference. Don't overthink it. These are pretty similar. Pick one and stick with it. Don't try to get cute. That's the whole thing. The S&P is close enough to the total stock market where it's not going to matter that much.
Yeah, I mean, whenever people talk small caps a lot, I just think about your stats you've shared before about how many companies go out of business over the long term. And those are usually probably the smaller companies, I would guess, right?
I'm not saying you shouldn't invest in small caps. All the large cap companies started as small caps, right?
I'm saying instead of just having a total market saying like, I'm going to concentrate in small caps, that always comes to mind for me.
Oh, right. Yeah, no, it's a good diversifier. There are periods of over and underperformance for both.
Yep.
Large has done way better than small recently. Small did better than large beginning part of the century. It happens.
Cool.
Next question.
Sounds good. All right, up next we have a question from Jay. Ben answered a question about how pensions fit into an investment plan last week. There was some discussion about Nick's blog post on valuing a pension. My wife is a teacher, so she still has a pension, not to brag. I was telling her last week that her pension is a huge asset for us, but what's it really worth? We're 35 and my wife can retire at 60. If she receives 80% of her final pay level, and we estimate that to be $100,000, she would get $80,000 annually. What's her pension worth to us? Can you put a number on it?
Ask me, shall receive. Let's bring in Nick Maggiulli from Dollars and Data fame. Works with us at Red Wealth. Nick, you were writing about this because VP candidate Tim Walz owns no stocks, but he has multiple pensions. And I was telling someone this recently. So he has a pension through the armed services, and I think for being a teacher, it's probably worth more than most people think. And I have some teacher friends too who say, listen, I'm broke. And I tell them, if you have a pension, you have more money, a bigger financial asset than you think. So how did you go about figuring out how to value these things?
Yeah, so there's a bunch of different ways we can do it. I want to focus on this question in particular because what I want you to think about when valuing a pension, there's two parts. In this case, first you want to value it okay, imagine we're 60. Imagine we're at the moment we get the pension. How much is it worth then? And then we have to bring it back to today, right? Because if you want to get today's value of the pension, today's value is obviously going to be lower because there's time that has to move forward.
Net present value and stuff. Yeah, it's worth more to you at 60 than it is today.
Yeah, so at 60, if we were to value that, right, you have $80,000 a year. You're going to do, let's imagine you live for 30 years. I mean, of course, someone could live longer, but let's just say 30 years. You're doing $80,000 a year. Let's use a 4% discount rate, something like that. You put that in a financial calculator, and you're going to get 1.3 million. Can we get a chart on for that? Simple financial calculator. You put in payment. That's $80,000. Periods. That's the number of years. Discount rate of 4%, we can debate the discount rate. I think 4% is a good one to use for things like this. And then you get to 1.38 million. That's how much it's going to be worth when you turn 60.
So wait, you use 4% though because of the 4% rule as a good hurdle rate?
Not necessarily. I mean, you can use that. I mean, but most of the time when you're trying to value pensions, discount rates, there's a huge argument about how to do this. Should it be higher? Should it be lower? How much risk there is? I think 4% is fair here. If it's not because of the 4% rule particularly, but that's one way you can look at this as well. So what I like to do is just take the present value of this thing, right? So that's what it's going to be worth once you reach retirement, like once your wife starts pulling on this thing, that's roughly how much it's worth then. Now what we have to do is we have to bring that back to today, right? And so to do that, you would take that $1.38 million, that's the future value now, and then you would just discount that back 25 years, right? They're 35 now, so they're 25 years until they hit that point. And so you just say like, hey, 25 years discounted back today, and it's worth $518,000. And to make this a little bit simpler for everyone, just imagine it today. If I give you $518,000 today and it earned exactly 4% a year for the next 25 years, it would be worth $1.38 million when they turn 60, right? And then at that point, you could pull 80 grand a year for the next 30 years, once again, assuming it's earning 4% a year, and at the end you'd have zero. Because if you do the math on that, if you do 4% on 1.38 million, it's only 55,000. So you're actually pulling out more than the portfolio is earning on its own, because you have you actually have a base to build off, so you can slowly dwindle it down. So over 30 years, you get down to zero. So my answer to you, my friend, is around 500,000. Up to maybe 750 if we say the pension's worth 2 million when you're 60. So it's anywhere between 500 to 750 as of today. That's like
if you change the rate to 3 or 5, there's a range there. So don't get hung up on the total value. The point is it's going to be a valuable financial asset to you in the future. $80,000 25 years from now is not going to be worth as much, right? Mm-hmm. Because of inflation. So that's kind of part of it, but still, I think they're using round numbers here. I don't think they actually know what her salary is going to be, right? It could be higher, so that amount she gets could be higher as well. So, but the whole point is that it's probably worth more than most people would assume. I think that's my understanding of this.
Yeah. So, and the other thing to say is, with the 4%, I'm assuming is a 4% inflation adjusted number. Why? Because by the time you're 25 years from now, I assume your wife's gonna be earning more than 100K. It's not even because even if her career takes off, I'm just saying just because of in general inflation, I would expect that to happen. So this is saying, let's just pretend we're using the same price level. It would be 1.38 million in today's dollars at age 60. So it's gonna be even higher if we do a nominal return. So I think that's the way to look at it. So. Yeah.
And kind of the point of your blog post is that you shouldn't just use one methodology, right? You give three and say, really, you should probably do all three of these, and then you have a range. So that's what you would recommend, right?
Try different things. You can divide by 4%, right? But I said 80,000 divided by 4% as if it's a perpetuity. That's $2 million. But that's $2 million, 25 years from now, which today I said is worth about 750. So you're looking anywhere from 500 to 750, pretty conservatively.
Cool. Yeah, that's good. Good stuff. Check out Nick's blog for more. Next question.
Okay, up next we have a question from Keith. As a federal employee, USPS city carrier, I get 4.4% taken out of each paycheck for the FERS pension. Should I count that towards my savings rate? I should receive a federal pension and Social Security. If we agree on the 4% rule, can one value a pension by dividing the annual income by 0.04? Can those pensions be my bond or cash allocation in retirement? And if I have two pensions, would it be fair to say I can be more risky in my investments now and through retirement and be 100% stocks or overweight small caps? This is the small caps thing that was in my brain from doing these questions. Yeah.
Okay. Yeah. Can we say thank you for your service for a mail carrier? I feel like that's fair.
Yeah. I think you can thank anyone for anything.
Okay. So obviously the last question teaches us that a pension should be part of your financial plan. And I know that the 4% rule isn't perfect. We talked about it the last one, but I like how so many of our viewers are using that as a baseline, at least, right? To set expectations. And so I think that makes sense. Obviously, it depends how much that pension income covers. I've never thought of a pension as a bond, as more of an annuity, I guess. So if you think I'm gonna spend $50,000 in retirement, my pension's gonna cover 30, my portfolio's got to cover the other 20, or something has to cover it. So how do you think, Nick, in terms of taking more risk because you have this piece there to fall back on?
I mean, for the most part, I would look at it more as a cash or bond allocation. If you actually believe that it's relatively safe, then I would think of it that way. However, the only counter I have to this is if you actually know what your pension, how whoever manages the pension, how they're investing that money, that is more indicative of how you would think about it, right? If they're 100% stock and you're 100% stock, and the stock market, we go through a Great Depression-like event, there's a very good chance you're not going to get a payout, you're going to get a reduced payout. So it's not as safe as you might think, depending on how they're investing the money. So normally I'd be like,
that?
I don't know exactly. I've never had one of these pensions. I think you can ask and they will tell you
there
this
are some ERISA rules with how they have to match assets and liabilities. The other way to think about this, though, some people think the way that you should invest your money should have a bearing on what kind of job you have. So the fact that he's a federal employee who has a federal pension, probably pretty safe. The job's probably pretty safe. My brother works for the federal government. He says it's basically impossible to get fired. The job's probably pretty safe. That pension's pretty safe. Does the job allow you to take more risk versus someone who is in a sales job and their income is variable or they get bonuses? Should they take less risk? Do you put any stock into that in terms of like how your job should impact how you invest?
Of course, yeah. That you should definitely think about that. And there's arguments to be made on both sides. Some could say, well, the federal government's running a massive deficit and they're not going to be able to pay at some point. So you could actually see that as more risky than another pension, right? So there's a lot of ways to look at this. I think you have to I wouldn't say it's 100% bond allocation or cash allocation in this case, but I would say it's mostly. I would say 75 to 80% it's cash. So I would do some sort of little adjustment like that. So I probably wouldn't be 100% stock in all my other portfolios. But that's the way I'm looking at it right now. If I had more information, I could give a better answer.
Yeah, I don't think you have to go to extremes, but taking a little more risk because of this, I think makes sense to me. You have that piece covered, and for as far as I'm concerned, this sort of annuity-like payment is way safer in retirement than thinking of a bond because interest rates can change and you never know what you're going to get from the bond side of the portfolio. So I think it makes sense.
I think big picture too, we get a lot of questions from people who say things like, can I even consider this as part of my retirement, considering something could happen and it might not pay out what it's supposed to? Or, I mean, the answer, just to be as simple as possible, is yes, right? You do get to consider that part of
I think
retirement.
most people should. There have been instances in the past where pensions get cut, but it's pretty rare. You never say never. It's never 100% or 0%. Right. But yeah, I think you consider it part of your financial plan for sure.
Okay.
All right. We got one more question.
All right. Last but not least, we have a question from Joseph. My time horizon is at least 15 years. I have a somewhat diversified portfolio of around $75,000. I have a similar amount managed by a professional that's more conservative. In the portfolio I manage for myself, I take some bigger swings. Some hit, some miss. I take tax losses when I think is necessary and hold on to some smaller risky bets. My question is about what I should do with my big winners that I don't feel comfortable selling because I think they have more room to run. I'm up on NVIDIA 200%, Microsoft 200%, and Apple 100%. Good job. That's not easy to do.
Nicely done.
In my heart of hearts, I feel like I eventually have to sell or at least trim, as very few companies stay at the top forever. Specifically, I don't think NVIDIA will hold its lead forever, but I do think they can continue to pay off for a few years to come. Part 2. Apple and Microsoft may never fall in my lifetime. Is there a steadfast rule on taking some off the table? I've heard Kramer say once your stock doubles to take your initial investment out, but I'm an investor, not a trader. And if I'm being honest, if I trimmed NVIDIA or Microsoft at 100%, I'd be mad. But I know they can go down. It's crazy, but I feel like I'm afraid to make money. Thoughts?
Okay. This feels like Joseph wrote the question laying on one of those couches in the psychiatrist's office, right? And just the back and forth and back and forth.
This question. Yeah.
We've gotten more questions about what to do with NVIDIA gains than any other stock or security in this show's history, I think, in the last 12 or 18 months. There's a lot of people who, good for them, are sitting on gains, but they are playing listen, I'm sitting on huge gains on one hand, but on the other hand, I don't want to get too greedy, and what happens if something, they fall. Nick, you wrote a piece on NVIDIA recently titled, Is NVIDIA Overvalued? The $3 trillion question. Daniel threw up the chart here. You did a price to sales relationship for NVIDIA today versus Microsoft in the dot-com bubble, and NVIDIA price to sales was even higher. Where do you fall on this? Because I'm kind of with Joseph here that trees don't grow to the sky. Eventually mean reversion kicks in, but I don't think anyone has a good plan of attack for how to approach this situation. Selling a stock is way harder than buying a stock. That's kind of where I come down to this. What do you think how to handle this from like a regret minimization standpoint?
Yeah, I think the fact that if you're asking the question, you should probably sell some of it, right? If you're not thinking about it, then I think you're like, oh yeah, it's fine. But if you're like, oh my gosh, this is kind of seems high, like maybe I should sell some of it, you should trim some.
So this is like your George Soros back pain. Like if you're that worried about it, you should lighten up a little bit.
Yeah, and the question, how much, that's the magic question. How do we know? Like someone could just say, just do half every time and keep cutting half all the time. I mean, that's a very simple heuristic, right? There's a lot of different ways of looking at it. It's funny, the day I wrote that post, I published it at like 8:30, so pre-market. NVIDIA went down, I don't know, 8-9% that day. That was just pure luck, obviously. I'm not actually that much of a fortune teller.
You weren't moving the market, Nick?
No, I don't think. Actually, I did have some people sell because of my article, but not many, mostly close friends. But I don't think they had any serious position sizing. But, either way, it's like my point is like this is one of those things where it's very hard to know the future. And like all I know is when price of sales is that high, either the price has to come down or the sales have to shoot up a ton. And if I had to guess which one's more likely, just in general, when you see something at, the 99th percentile price of sales and it's one of the biggest companies in the world, it doesn't look good. And of course, it's ironic that I show Microsoft as the before, and now Microsoft is much bigger, but like this is just like a very crazy thing. So yeah, I would definitely say to cut some down. The problem is, even when we give these recommendations, I'm going to say that, and then guess what? Over the next 3 to 6 months, NVIDIA can go even higher, and you're like, wow, Nick, you're such an idiot. But I'm willing to bet that one day it will be far lower than what the price is, today. I don't know where and when that is or what's gonna. It may not have to do with NVIDIA. It could just be another outside event, and then bam, like all the money starts coming out of these stocks, and it has nothing to even do with NVIDIA or the fundamentals whatsoever.
Yeah, if you get to a point where there just aren't any other buyers to come in, right? There's no more demand. I love the Grand Rapids hedge of just I'm going to sell half my position, or I'm going to sell the original cost basis, and let the profits ride, whatever it is. I think having some sort of rebalancing mechanism, or this thing was 2% of my portfolio when I bought it, now it's 10%, I'm going to go back to 5, whatever. I think just having some sort of rules ahead of time, I think that's the hard part for most people is they buy a stock and they think, I just hope it goes up forever. And there's no exit plan, or there's no plan of what to do to kind of manage the position. Even if you think NVIDIA is going to be a great hold for the long term, you could still set some rebalancing parameters around it because it's probably going to continue to be a very volatile stock.
Yeah, that's very true.
Can I tell 2 quick stories?
Let's do it.
So years ago, I bought GameStop in the low single digits, and then sold it for a double, right before, like literally the month before the meme mania, where the stock ran up. That hurt. That hurt. But you know what hurts a lot worse to me, anecdotally, just speaking for myself? I was a ChargePoint investor. And I think I was up 50, 60% at some point. And I was like, man, this is the future. I'm going to keep holding it. And long story short, after a couple of years, I sold it for a 70% loss. That feels a lot worse. That feels a lot worse to me personally.
Oh, right. A stock that you had a big gain, and the gain gets completely wiped out.
Watched
and then
it go to a massive loss. That hurt way more to me than like missing out on a bunch of upside.
Yeah, I guess at least if you sell a stock early, you still say, I locked in some gains. Right? Yeah. You can always do the Isaac Newton thing and get back in later, right? At the peak of the bubble. But yeah, this is one of the hardest things to answer, especially, Nick, you said your friends asking you for advice or whatever about this, because whatever you're going to say, whatever you say, you're probably going to, you're going to be wrong about something, unfortunately. And this is the thing, is that with these things, you can never tell. And the crazy thing about NVIDIA is, Nick, you showed in your post, the fundamentals for the stock have actually, it's not like the company is a total bubble or something. The fundamentals have been there as well. And so, yes, I still think this is the regret minimization framework of what are you gonna regret more? You sell some of the stock and it continues to go up, or you hold on for dear life and it crashes by 50%, and then now what?
Yeah,
Dave,
I think
Dave in the chat is reminding everyone that I'm an artist, not an advisor. So just for what it's worth, there you go.
Yeah, I think the main thing to keep in mind is don't go from 100 to 0. Like, I think those big all-in moves are kind of scary. So, if you're going to do something, pare some back. Because if you go to 0, you're going to regret it if it goes up, right? Obviously, if you hold all of it, you're going to regret it if it goes down. So you got to kind of hedge that in some way and something you feel comfortable. And I also think, another piece of this, which we're not talking about, is, what do you need the money for? For a lot of people, this is just a game, right? It's just in their head about winning money. And it's how is that going to change your life? If it were to double, would it change your life? If it were to get cut in half, would it change your life? I'm guessing for most of these people, it's probably no on both cases. So it's really just like an ego game you're playing. But if it would change your life if it went down, then maybe you should pare back very seriously, right?
Yeah,
so
if
that's
you're,
how I think about it, yeah.
If you're holding it in a taxable account and selling that position, you could lock in the gains and use it for something else, then that sounds like a good use of profits for me. I'm going to take it and use it for a down payment for my next house, or I'm going to buy a boat, whatever it is. That makes sense to me. So that's a good point. All right. Make sure you go check out of Dollars and Data. Nick has a great weekly newsletter. I don't think you can sign up right on the blog, I'm sure. Right, Nick?
Yep. Check it out once a week.
All right. What are we writing about in the future? Anything on your plate?
Next week, I'm talking about the low stability of high income. So I'll just tease that out. So
all right. I think I get this. So, the people
there's
who
a
are in the
Reddit
highest
post.
income brackets don't stay there forever, right?
Yeah, or like there's people who have, my total comps is some tech employee. My total comp's 750, and then they get laid off, and the best they can find is like 200, 250, and they're like, what? That's like a wreck on their life, especially if they have a big mortgage. And
All right, I like it. Of dollars and data.
Yep.
Check it out. Email us, askthecompoundshow@gmail.com. Tons of questions in there. We always like them. Subscribe.
Lots of people watching right now. Thank you. Over 2,000 people watching.
Yeah, thanks for everyone on the live chat. Thanks for everyone on Twitter. See you next time.
See you, everyone.
Thanks, guys.